Now, today's jobs numbers are mixed news for the bond market. Treasury yields rose on expectations the Fed might raise rates sooner than expected, but the cost to protect corporate bonds against default fell since the data suggested a stronger economy. Joining us now is Dan Fuss, Vice Chairman of Loomis Sayles. He co-manages the $18.7 billion Loomis Sayles Bond Fund and has been nominated by Morningstar. I know you're very modest, but as Bond Fund Manager of the Decade. That's quite an incredible title. I know they don't make the actual confirmation until January, I think.
Right.
But congratulations on that, first of all.
Thank you.
Let me ask you what you think about today's jobs numbers, first of all. I mean, from the perspective of the bond market, what does it say to you?
The bond market and all the financial markets tend to respond instantaneously because of the various amount of hedging in the market. So a surprisingly good jobs number means treasuries go up, stocks go up. Treasury yields go up, prices go down, stocks go up, and corporate bonds are somewhere in between. Lower quality, higher yielding bonds tend to follow stocks. Higher quality bonds tend to follow treasuries. And that's an instantaneous reaction, and you have to be very, very, very careful of taking a 1 month sample, which is what that number is, and drawing any lines from it. Having said that, it was good news relative to what was expected.
And not just good news, Dan, but much better than expected.
Much better than, again, you're dealing with surveys and samples. You have to be careful. It is better than expected. That drives the increment markets, okay, the incremental trade. It doesn't necessarily mean all things are all that better or all that much worse. But it is good news. It's a long, cold winter, and all of a sudden you see a robin out on the lawn.
Does it mean in terms of strategy, you're not making any kind of significant changes to strategy? As you said, it's 1 month's worth of data here.
Right. If you were a day trader or a very short-term horizon, you would change.
Right.
Because the short-term horizon psychologically has changed. The money flows haven't changed.
What if you stand back and take a bigger picture look for government bonds, for treasuries? What do you think we're going to see this year? Because it started out that people were saying shorting treasuries, Mark Faber, I think, said, is the slam dunk trade of the year, and pretty much everybody was on board with him.
Yeah. I wouldn't short anything in this type of environment that's completely market sensitive and driven by incremental news, because you just don't know. That sample could have come the other way. And so I'd be very careful that I do think the longer-term outlook for Treasury yields is that my guess, underlying the word guess here, my guess is that Treasury yields, with a lag here, of perhaps as long as a year or a bit more, are going to go up. And I will, when we get together 20 years from now and talking about, you'll say, hey, Dan, how come Treasury yields have gone up for 20 years? Because we're running bigger deficits. And the Treasury is going to be your incremental borrower of funds. That's the thing you have to deal with in the markets. The shorter-term stuff is fine if your horizon is shorter term.
And the demand is there. I mean, we are obviously selling a lot of debt. We sold a lot of debt this year, and we'll continue to do that to support these deficits.
Right, and quite a bit of the debt is sold offshore, particularly the short-term debt, particularly the bills. That's sold offshore.
In terms of yields, though, can you give us any idea in terms of what kind of moves you might anticipate in the next 6 months? We talked earlier about expectations for the Fed, so I'm just curious where you see rates going.
As far as Treasury rates, I think right now, because of the support for the market that you have in the bill market from offshore money, and the both direct, which is going away, support for the notes, 2 years, 3 years, 5 years, 10. From the central bank directly through some buying, that's pretty much over. But indirectly through the buying of mortgages, that's not over. And that's probably going to go on. It would be reasonable to expect that for a while, until the private economy recovers, that probably, with the help of our friends offshore, we can keep the yield distribution pretty much as it is as long as we want to. Once the private economy kicks in,
then things change.
Then things change, and the Fed has less reason to hold the rates down.
All right.
Dan, thanks so much for joining us. Dan Fuss there of Loomis Sayles.